Are you planning for retirement, or maybe you are just planning for financial independence? Either way, the one thing you want to consider is a tax plan. Why is that? Because depending on the plan that you have in place, that can help you get there faster, or if you have no plan in place, it's going to potentially have you a few steps back, or maybe many steps back from achieving those goals, right? So today we're going to talk about the 5 mistakes that I've seen, either from clients, prospects, individuals that I've worked with in the past, the mistakes that they have made, and how that has, caused challenges, and ways we could overcome these challenges, and ways we could overcome these mistakes. So we're going to talk today about those 5 mistakes that I've seen with tax planning mistakes that I've seen for individuals who are planning for their retirement. The first one is having no tax plan in place. No, if you don't have any type of plan, and this is usually people who are just sporadically just doing things and invest here, just there, and just hoping for the best, no type of plan, no consideration whatsoever, then obviously there's a challenge there, right? Retirement is, depending on your circumstances, may not be an easy feat. It already has its challenges with the economic environment that we're currently in, and the economical environment that's always there. They're always changing things. And so if you're not intentional with a plan, you're already, putting additional obstacles in your way. So not having a plan, that's the first big mistake. You may have somebody who files your taxes. You may have an advisor who sold you an insurance policy, and you go to the bank and you get some investments. Things are just happening, all these moving parts, but nothing really makes sense. That's a big challenge, because what you have is an inefficient tax plan there, and quite frankly, no plan at all, just things moving and you're hoping for the best. And of course, with that situation, things aren't likely to work in your favor. The next thing is, maybe you have investments and you're being intentional about the investments, and you may even have, some that's in an RSP and some that's in a TFSA. But if you're not being intentional and strategic about the specific investments, then that's a challenge, right? So you want to choose tax efficient investment options such as RSPs or TFSAs. If you're in a corporation, there might even be certain life insurance policies that make sense for you. You should also have a sense of, okay, these different investments and how are they treated. If I'm earning interest income, well, that's going to be the highest thing, the highest type. It's going to be treated as ordinary income. Capital gains, you have a 50% inclusion rate. You might have dividends. So you want to have a sense of, okay, these are the different opportunities. These are the different vehicles that I have, and this is how I'm going to invest. And I'm investing, and I'm being strategic about how I invest, because now I know this is a tax efficient vehicle, and the reason why it's a tax efficient vehicle, and how it's going to benefit me. Because you could have the same stock. That same stock could be in a non-registered. That same stock, or could be in a TFSA. You could have it in a RSP. It all depends. So if you're not thinking on tax efficient investments and how these different vehicles work, you're already not putting yourself in the best position. No, maybe you did everything correctly. You put things in tax efficient vehicles. You've got all the benefits of a tax deduction, tax deferrals, and even have the benefit of being able to withdraw money tax free. Well, here's the thing. From a withdrawal standpoint, an overall withdrawal standpoint, when you get to retirement, or if you need money in the future, you have to consider being strategic about how you pull your money out. So one thing to accumulate it, it's another thing to withdraw the money, right? So here's the thing. You could have done a great job, but then you get to retirement and you're just pulling from all these different things. Like I said in another video, the challenge with retirement is this. Before retirement, most people have income from one source. It's kind of straightforward. If you make income from as a salary, it's treated one way. Dividend treated another way. Capital gains, you just know exactly how it's going to be treated. But once you get to retirement, you have all these different sources. You have CPP, you have OAS, you probably have a pension, you have GIS, basically circumstances might have GIS. You have obviously RSPs. You have all these different sources, and they're all treated, depending on how you earn them, they may be treated differently. And so you go from having one income source and knowing exactly potentially what you're going to pay, and now you have all these different income sources, and you might have a certain amount that you need to withdraw. So you need to take 100,000. Okay, well, should I take it from here, TFSA? Should I take it from RSPs? And the beautiful thing here is that's the opportunity for tax planning, because at the end of the year, top of the year, you could sit down and say, okay, I need 100,000, 50,000, 60,000, whatever your withdrawal rate is. And you look at that and you could go, okay, if I put 30 from here, 20 from here, 5 from here, you know, whatever amounts you're pulling, you could essentially have a sense of how much you will pay in taxes. So the beautiful thing about this is if we plan, if we give ourselves enough time to plan, we can be strategic about how much taxes we pay, right? And so having a appropriate withdrawal strategy would have undone everything that you've worked for, because you probably did great with the tax deduction, the tax deferment. And now you're at the point where, okay, we could also be even more efficient, but if you pull it the wrong way, then potentially what you have is a huge tax bill. And it pisses you off because then you go, well, I'm supposed to be saving all this money. Well, that's the challenge here. So having a poor withdrawal strategy is a mistake that I have seen. And again, the opportunities that you have in sitting down with a client, with me, when I sit with a client and we're strategic each year about where to pull money from. And given the environment we are in now, where you have inflation, you know, we may need to revisit that a couple times throughout the year. But at least, again, we're being intentional. And when we pull money, we have a sense of what the tax ramifications of those things are. And we're also looking at the long-term strategy. So what's mistake number 4? So mistake number 4 is not having someone, either yourself or your accountant, not looking at the potential tax credit or deductions that are available, right? So if you miss valuable senior tax credit and deductions, okay, maybe not a lot here, but over the long term, it could really compound. So you want somebody that's not only filing your taxes, but you know, at least has tax planning as part of the thing they're considering while they're filing your taxes. Now, every year this changes, so you want to stay on top of things. Or if you have an accountant, you want to have an accountant be doing that. The next one is not considering your estate plan. It's one thing you did amazing with retirement, and then you have assets that when you die will be, you know, treated as a disposition and potential huge tax ramifications. Just recently I gave a talk and I was speaking with an individual and he had a second property, and we looked at it, and you know, just from having a conversation, you know, he was aware, and based on our conversation he was trying to see if there's something that could be done, but he was quite aware that this asset that he had, second property, going to be hundreds of thousands of dollars in taxes that he would have to pay. Now, if we had sat down and planned this, you know, many years before, could have, you know, I'm not saying not get to a point where he paid no tax, but potentially we could have saved him a lot. You know, maybe trigger a disposition, maybe buy a life insurance policy, you know, whatever. The opportunity would have been in the past, not now when you have this tax bill and given your age and circumstances. So while you're planning for retirement, it shouldn't stop there. You should go a step further and also consider your estate plan. What does that look like, right? And you consider different opportunities there for tax planning. So those have been the 5 tax planning mistakes I have seen from, you know, clients who have come to me, and now we've worked together, and of course we've rectified these things, or we at least are in the process of doing so. So hopefully this was helpful. If you found it helpful, like, share, subscribe, leave a comment, ask a question. Look forward to talking to you soon.